Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know First Arm challenges Nvidia with its first AI chip, forecasting $15 billion in revenue by 2031. We'll analyze why this pivot from licensor to direct competitor is a turning point and how it could affect the entire AI semiconductor landscape. Second, Tesla's Cybertruck faces death trap allegations amid a wider AI GDP paradox in Silicon Valley. So we'll discuss why tech's massive AI investments aren't boosting productivity and what this disconnect means for the economy. Third, Meta's moonshot compensation plan demands an 88% stock surge to reach a $9 trillion valuation. We'll explore how this high-risk incentive could transform the company's AI strategy and force a shift towards aggressive monetization. Fourth, HBM chip leader SK Hynix seeks a $14 billion US IPO, sparking a showdown with its own investors. This discussion will reveal how the conflict over share dilution connects to the global AI arms race and what it means for future tech investments. Fifth, the creator of the Metaverse has expressed skepticism about Meta's headset strategy, suggesting it may not be the future of the Metaverse. In this episode, we'll break down this stunning reversal and what it signals for the future of face-worn computing ecosystems. The company that for decades has been the quiet partner to the world's biggest tech giants just rocked the entire industry. The firm that licenses the chip designs inside almost every smartphone is no longer staying behind the scenes. They are now stepping into the ring to compete directly with their own customers, including Amazon, Microsoft, Nvidia, and Google. We previously analyzed how the CPU was becoming a bottleneck in AI systems. Well, now ARM is stepping in with its own silicon to attack that choke point. For years, ARM succeeded by being the Switzerland of the chip world, a neutral party licensing its designs to everyone. By making its own chip, it risks shattering that neutrality. This could push customers to accelerate investments in RISC-V, an open source rival that has already hit about 25% market penetration. This all centers on their first ever in-house chip, the AGI CPU, designed specifically for the AI data center gold rush. So what makes this chip different? It's a specialist. Built on the new ARM v9A architecture, it has features called scalable vector and matrix extensions. In simple terms, this allows the CPU itself to perform the complex matrix math essential for AI inference, a job usually handed off to power-hungry GPUs. It doesn't just manage the GPUs, it helps feed them, directly addressing the orchestration bottleneck we flagged a while back. And the number they just dropped alongside it is an absolute bombshell. ARM projects this single new chip will generate $15 billion in revenue by 2031, though specific projections for the AGI CPU are not publicly available. To really grasp how audacious this forecast is, consider Intel. Its server chip division, a huge part of its business, was part of a company that peaked around $79 billion in total revenue. For a single new product line from a new market entrant to aim for $15 billion shows extreme confidence. Now, you might be asking, doesn't a company like Meta build its own custom AI chips? Yes, they do. And that's what's so fascinating. The reality of modern tech development is that custom silicon is incredibly expensive and risky. AI models evolve so fast that a chip can be obsolete before it's even deployed. By also buying a powerful off-the-shelf chip like ARM's AGI CPU, Meta gets flexibility and reduces risk. It's a hybrid strategy that shows just how complex this AI arms race has become. Meta is confirmed as the first official partner, and they're joined by other titans like OpenAI and Cloudflare. This also sets up a collision with Nvidia's push to keep the CPU as a commodity. ARM is signaling it wants a bigger role, and this has huge geopolitical implications. ARM is a UK-based company. In a world dominated by US and Chinese tech, this new chip offers a powerful non-Nvidia alternative for what's being called sovereign AI. Countries in Europe, India, and Japan are desperate to build their own AI capabilities without getting caught in US-China export controls. The message is clear. ARM is no longer content just selling the blueprints. They are now building the skyscrapers themselves. From one tech giant making a bold, risky move in the chip space, let's turn to another whose high-stakes gambles are facing some very real-world consequences. The truck Elon Musk calls apocalypse-proof has reportedly locked passengers inside during fiery crashes. with some fires burning so hot they have disintegrated drivers' bones. The Guardian has tracked 5 known fires involving the Tesla Cybertruck, a significant number considering only 60,000 have been sold, resulting in 4 fatalities. Families allege the truck's design creates a death trap, the electric door handles can fail, there are no external handles, and its high-density windows are harder to break. What's so jarring is that despite these horrific allegations, the Cybertruck actually secured a 5-star overall safety rating in early 2026. It passed the tests. The situation presents a fascinating duality. On one side, you have official safety on paper, while on the other, it exposes the potential danger of unconventional designs in the real world. But this isn't just about one vehicle's flaws. It's a symptom of a massive gamble happening across Silicon Valley. Take Meta. The company that literally changed its name for the Metaverse is now gutting that division, which has lost a staggering $80 billion since 2020. Mark Zuckerberg is even reportedly developing a personal AI agent to assist with his own CEO duties. To that point, Meta is considering laying off up to 20% of its workforce, around 16,000 employees, to offset its ballooning AI expenditures. You see, this isn't just about cutting costs. This is what some are calling the Great Capital Reallocation. Meta plans to invest a mind-blowing $600 billion in AI infrastructure by 2028, shifting value away from human talent and toward pure computational power. This all-in bet on AI is creating a chasm. Nvidia's CEO predicted his company would rake in $1 trillion through 2028, and you have to understand what they're actually selling. These aren't just chips for video games, they're for AI agents, autonomous systems for businesses. Yet polling shows 65% of Americans don't use AI at all. This is the heart of what economists are calling the AI GDP Paradox. You have astronomical financial projections, but over 80% of companies have seen no measurable productivity gains from their AI investments. The evidence suggests the value is concentrating at the very top, with the net worth of the top 10 US. Tech leaders surging by over $500 billion in 2025 alone. We were just talking about Meta gutting its staff to fund a massive AI pivot. Now, it turns out they're also dangling an almost unbelievable carrot for the executives leading that charge. The company is offering a massive new stock plan, but there's a catch. For the first payout to even happen, Meta's stock has to soar by 88%. And believe it or not, that's just the starting line. This kind of plan is what's known as a moonshot compensation strategy. It's designed to do more than just motivate. It's a high-risk, high-reward psychological tool that can spark innovation but also encourage dangerously risky decisions. This isn't just business, it's a high-stakes gamble on human behavior. This is Meta's all-in bet to catch up in the brutal AI race, as it plans to spend up to $135 billion this year alone. Now, a key part of that struggle, something not widely understood, is the company's technical debt. Meta's entire infrastructure was built for social media, not for the massive, power-hungry demands of training foundational AI models. So they are essentially trying to overhaul the company's DNA while the race is at full sprint. And that $135 billion figure, that level of spending is so enormous, it rivals the AI strategies of entire countries. This is what experts are calling sovereign AI, where a private corporation builds an infrastructure so powerful it competes with national interests. It raises huge questions about who will control the foundational technology of the future. When we place Meta's recent performance alongside its rivals, the contradiction becomes clear. Over the past year, Meta's stock dropped about 4%. In that same period, Google's parent company, Alphabet, has skyrocketed 73%. This new incentive plan is Meta's attempt to reverse its fortunes on an incredibly aggressive timeline. But here's where it gets interesting. That 88% stock jump is just the first hurdle. The plan's highest target requires the stock to hit a staggering $3,727 per share. Reaching that goal would value Meta at over $9 trillion more than double the current value of Nvidia. It forces a fundamental question: how could they possibly generate that much value? The answer may lie in a major strategy shift, moving from open source models that don't make much money toward proprietary, directly monetizable systems that put shareholder value above all else. Meta is betting billions on its internal AI strategy, but the entire ecosystem runs on specialized hardware. Speaking of which, the undisputed leader in one critical component is making a massive move of its own. South Korean chipmaker SK Hynix has confidentially filed for a US listing, and the numbers are staggering. The company is looking to raise between $9 and $14 billion, which would make it the biggest US listing in 5 years. The money is earmarked for a single purpose: to build a war chest for the AI revolution by financing new chip-making factories in South Korea and Indiana. You see, this isn't just about building factories. That Indiana plant is a key part of a trend called friendshoring, where companies build critical supply chains in geopolitically aligned countries. By investing nearly $4 billion in Indiana, SK Hynix is embedding itself into the US semiconductor ecosystem, aligning with policies like the CHIPS Act. This all ties into something in the financial world called the Korea discount, where South Korean stocks often trade at a lower value than their global peers. Interestingly enough, SK Hynix is the dominant player in high bandwidth memory, or HBM, the super fast chips essential for AI. They hold a staggering 57% of the market, yet their total company valuation is roughly 27% lower than their main US competitor, Micron. They are the market leader, but are valued like they're in second place. US listing could help close that gap by tapping into deeper capital pools. However, this is where the situation takes a more complex turn. Investors are publicly pushing back. An influential shareholder advocacy group says it is opposed to the company issuing new shares, arguing the move would dilute the value of existing stock. One fund manager called the decision disappointing. This highlights a fundamental difference in corporate strategy. In the US, a company might use existing treasury stock to avoid dilution, but SK Hynix is choosing to issue new stock, putting its aggressive growth plans ahead of the immediate value for its current investors. These investors are demanding a different path, urging the company to buy back 10 to 15% of its own shares for the listing. It's a high-stakes showdown between a company racing to dominate the future of AI and its own shareholders who are refusing to let their value be diluted to pay for it. While SK Hynix is raising billions to fuel the future of AI hardware, the visionary behind another multi-billion-dollar hardware bet is now calling it a total dead end. The man who literally invented the word Metaverse, Neal Stephenson, just went on the record calling Meta's entire hardware strategy a creepy dead end. Stephenson, whose novel Snow Crash inspired Facebook's name change, now says he no longer believes face-worn computing is the future. His exact words: "People don't like wearing things on their faces and don't trust those who do." Then he dropped another bombshell, declaring there is no business case for headsets anymore. This is a stunning reversal, especially when you consider the money involved. Since late 2020, Meta's Reality Labs division has lost over $50 billion. They are burning money on a scale that is hard to comprehend, all while the man who inspired the dream is now publicly declaring it a financial dead end. Stephenson admits he used to believe we wouldn't still be staring at little rectangles in their hands in 20 years. His new answer, a definitive yes. He now believes we will be, if the only alternative is wearing things on our faces. So the thing is, the reason the smartphone is so hard to replace comes down to its incredible network effects. It's not just a device, it's our camera, our wallet, our connection to everyone. The entire app ecosystem creates a gravitational pull that is almost impossible to escape. And that creepiness, he mentioned, it's not just about aesthetics. It's a deep-seated psychological and social barrier. Unlike a smartphone, which you have to obviously point to record something, smart glasses can capture video and audio discreetly. This creates a fundamental sense of unease, a hurdle that face-worn tech from Google Glass to today has still not overcome. While Stephenson seems fine with the term metaverse applying to simpler games on a screen, his public takedown of the hardware is a massive problem. After all, this isn't just a convenient redefinition, it's a clear signal of a major strategic pivot. After the pure VR vision failed to gain mass adoption, Meta is now shifting its flagship platform, Horizon Worlds, to be mobile first. They are essentially moving the goalposts to where the audience already is on their phones. It's a retreat from the original, immersive vision, and a quiet acknowledgement that the grand multi-billion-dollar plan may have been fundamentally flawed from the start.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.